In 2025, the United States recorded one of the highest levels of corporate bankruptcies ever seen outside a recession. Tens of thousands of businesses collapsed on paper, even as the economy kept growing. Markets hit record highs, and capital flooded into AI and energy. So why are companies failing in industries that are supposedly resilient? In this video, you'll learn how bankruptcy stopped being a last resort and became a financial strategy. One designed to transfer risk, reset debt, and generate profit for a small group of owners. But first, we need to understand how corporate failure was redesigned to work this way. Segment 1. The debt trap. To understand what's actually happening here, we need to talk about private equity. And before your eyes start glazing over, stay with this, because it's simpler and more ruthless than it sounds. Private equity firms raise billions of dollars from pension funds, college endowments, and wealthy investors to go out and buy companies. The pitch? Find undervalued businesses, improve them, sell them for a profit. Clean, simple, capitalism at work. Except that's not what actually happens. Let's say a private equity firm raises $1 billion. They go shopping and find Medicare Solutions, an urgent care clinic chain worth $1 billion. Now you'd think they'd use that $1 billion they just raised to buy the company, right? Nope. They use $300 million of investor money and then borrow the other $700 million. But here's the genius part. The firm doesn't borrow that money. They make the company borrow it. So the moment the deal closes, Medicare Solutions goes from zero debt to $700 million in debt. The private equity firm owns the company, sure, but they're not on the hook for that debt. And then they immediately start extracting value, management fees, usually 2% of assets annually, transaction fees for arranging the buyout, monitoring fees for oversight, and then once the company is sufficiently leveraged, they often have it borrow even more money just to pay themselves a special dividend. Load the company with debt, extract cash early, let the company carry all the risk. If things go well, the firm sells the company for 4 or 5 times what they put in. If things go poorly and the company collapses under the debt, the firm only loses their original $300 million. Not the $700 million the company borrowed. Massive upside, capped downside. This incentive structure doesn't just tolerate bankruptcy risk, it actively encourages it. This is called a leveraged buyout. And when interest rates were basically zero for almost 2 decades, this strategy worked beautifully. A $700 million loan at 2% interest only costs $14 million a year. Totally manageable for most functioning businesses. But then something changed in 2022. Interest rates tripled, and suddenly that same $700 million loan at 5% interest now costs $35 million a year. For a lot of companies, that's the difference between profit and bankruptcy. According to Moody's, there's $1.87 trillion in what they politely call junk debt that needs to be refinanced between 2024 and 2028. Most of it is held by companies that were bought out by private equity firms during the cheap money era, and now those companies are drowning. In 2025, private equity-backed bankruptcies actually dropped to 66 filings, down from 81 the year before. But don't let that number fool you. Those 66 bankruptcies accounted for 56% of all large bankruptcy cases, companies with over $500 million in liabilities. They're not going bankrupt less, they're just getting better at hiding it. More on that in a second. And the industries getting hit the hardest reveal something important about how leverage works. These aren't weak industries, they're industries that should be thriving. But leverage doesn't just amplify profits, it amplifies every single vulnerability. Healthcare saw 13 major filings in 2025. The thing about healthcare is that it operates on incredibly thin profit margins, usually 3% to 5%. When private equity adds massive debt servicing costs on top of that, there's literally no room for error. A small policy change that cuts Medicare subsidies by even a few percentage points can push a leveraged healthcare provider straight into insolvency. Real estate? 187 filings. That's 35% of all business bankruptcies. Commercial office buildings were bought at peak valuations using 70% or 80% leverage. The assumption was 90 to 95% occupancy forever. Now, with remote work driving vacancy rates to historic highs, rental income has collapsed. But the debt payments haven't. The buildings are worth less than the mortgages. Refinancing at current rates is impossible. So they file. Energy companies like Nikola Motors and Sunnova had customers. They had revenue. They had actual demand for their products. What they didn't have was the ability to service the debt that had been loaded onto them while surviving commodity price swings and policy changes at the same time. Strong industries failing, not from market conditions, but from financial engineering. So private equity creates the conditions for failure. But here's where it gets truly sophisticated. They've also figured out how to profit from the collapse itself. Segment 2, Chapter 11, the reorganization tool. When most people think of bankruptcy, they think of Chapter 7, total liquidation, assets sold, employees laid off, company ceases to exist, game over. But that's not what's happening with most of these high-profile bankruptcies. Instead, they're filing for Chapter 11, reorganization. It's supposed to give struggling companies protection from creditors while they figure out how to pay back what they owe. Operations continue, employees keep their jobs, and ideally the business emerges healthier on the other side. That's the theory anyway. In practice, Chapter 11 has become something very different. The moment a company files, all debt collection stops. Creditors can't sue, they can't seize assets, they can't force liquidation. Everything freezes while the company works out a reorganization plan. And here's the key part. Management usually stays in place. The same executives who loaded the company with debt, who extracted dividends, who drove it into insolvency, they get to keep running the company. Courts often prefer this because existing management supposedly knows the business best. The company also gets access to something called debtor in possession financing, DIP loans, special loans that let the company keep operating during bankruptcy. And because DIP loans get paid back first, ahead of everyone else, lenders are actually willing to provide them even to bankrupt companies. Now here's the part that should make your blood boil. Those executives, they often get paid millions of dollars in performance incentives to guide the company through bankruptcy. After the Enron scandal, Congress tried to ban bankruptcy bonuses for executives, but they left a loophole you could drive a truck through. Executives can't get retention bonuses just for sticking around, but they can get performance-based incentives for doing a good job managing the bankruptcy they helped create. Think about that for a second. The people who created the problem get paid millions to clean it up. And because the payments are structured as incentives tied to specific milestones, like completing a sale or meeting debt repayment targets, they're completely legal. In 2025, there were 7,940 Chapter 11 filings, up 1% from 2024. Genesis Healthcare, one of the largest nursing home operators in the country, filed after federal subsidies were cut and debt payments became unsustainable. Sunnova Energy collapsed under $2.4 billion in debt as policy incentives shifted and refinancing became impossible. These companies didn't fail because of bad business models. Genesis had facilities full of patients. Sunnova had tens of thousands of customers with long-term contracts. They failed because the debt loads left zero margin for error, and Chapter 11 gave them legal protection to restructure, which usually just means preparing for sale. And that sale happens through a mechanism specifically designed to benefit buyers. It's called a 363 sale, and it's the real moneymaker. Segment 3, the 363 sale. Section 363 sales allow bankrupt companies to sell their operations, brand, contracts, employees, physical assets, free and clear of most liabilities. Translation: the buyer gets all the good stuff without inheriting the debt, the lawsuits, the pension obligations, or the environmental cleanup costs. It's like buying a foreclosed house, except you don't have to assume the mortgage or fix the foundation. Just walk in and take the keys. And because these sales happen in bankruptcy court, they move incredibly fast. Regular corporate acquisitions can take 6 to 12 months of negotiation, due diligence, and regulatory review. Major deals can take years, but a 363 sale done in 2 to 6 weeks. The court picks a stalking horse bidder who makes the first offer and sets the floor price. Other buyers have a short window to submit higher bids. If someone outbids the stalking horse, the original bidder gets a breakup fee as compensation. If nobody else bids, the stalking horse wins by default. And guess who the stalking horse bidder usually is? Another private equity firm. Or, and this is where it gets truly absurd, sometimes the same private equity firm that originally owned the company. Here's how that works. A PE firm bought a healthcare company 5 years ago for $500 million, $150 million equity, $350 million debt. Over those 5 years, they extracted $200 million in fees and dividends. Now, the company can't service its debt and files Chapter 11. The PE firm can actually bid to buy the company's assets through a 363 sale, sometimes using the debt they're owed as currency in what's called a credit bid. They reacquire the cleaned-up company for pennies on the dollar, having already extracted most of their original investment. Creditors get far less than they're owed. Employees might keep their jobs or get immediately laid off. The PE firm? They made money on the way in, money on the way through, and positioned themselves to make money on the way out. Real examples from 2025. Hooters filed for Chapter 11 and was sold back to its original founders via 363. Shed the debt, closed underperforming locations, kept operating. Party City went through bankruptcy, got acquired by a PE firm, was loaded up with more debt, and then filed for bankruptcy again just 14 months later. Rite Aid, the pharmacy chain, filed for bankruptcy twice in 2025, 8 months apart. Pieces were sold to CVS and Walgreens, which expanded the geographic areas where those two companies are now the only options for prescriptions. This creates local monopolies, not nationwide. Regulators would actually notice that. But in specific towns and rural areas, there's now one pharmacy, one urgent care, one option, and because 363 sales move so fast, the Federal Trade Commission often doesn't have time to conduct proper antitrust reviews. Even when they do catch up, they face an impossible choice: block the sale and thousands of jobs disappear through liquidation, or approve it, and competition disappears in dozens of local markets. They approve. Almost always. The failing firm defense, the legal argument that the company's going to disappear anyway, makes blocking these transactions nearly impossible. Which brings us to the full picture, because this isn't a series of isolated events, it's a repeatable system. Segment 4. The cycle. Let's connect all the dots here. PE firm buys a company using massive borrowed money, immediately extracts fees and dividends. Interest rates rise. Company can't make payments. Files Chapter 11. Executives get millions in performance incentives to manage the bankruptcy they helped cause. Assets get sold via 363 sale, often back to PE, sometimes the same firm. New owner reloads the company with even more debt. Cycle repeats. Bloomberg found that between 2023 and 2024, 60 large companies filed for bankruptcy 2 or more times. Party City, Rite Aid, dozens of others that never made headlines. These aren't failures, they're features of the system. The time between bankruptcy filings is getting shorter. The debt loads are getting larger with each cycle, and the same companies keep circulating through the same private equity firms. These are what economists call zombie companies, businesses that aren't economically viable on their own, but are kept alive through financial engineering, debt refinancing, and repeated bankruptcies. Before 2022, low interest rates masked the problem. Zombies could refinance cheaply and stumble forward. But with rates at 4 to 5%, the life support system is failing. And here's what makes it even more insidious. Many of these bankruptcies are now happening in private. Instead of filing Chapter 11 publicly, companies are settling with creditors out of court in what are called distressed exchanges. They trade debt for equity in private deals that don't show up in official statistics. Cornerstone Research found that these out-of-court restructurings hit a record high in the first half of 2025. So when the data shows PE-backed bankruptcies dropped from 81 to 66, that's misleading. The public ones dropped, the private ones surged. The crisis didn't get smaller, it just got harder to see. And who's funding all this now? Private credit firms, non-bank lenders with less regulatory oversight, willing to lend to junk-rated companies at 10 to 15% interest. According to PwC, private credit has become the primary financing source for distressed PE-owned companies. It's more expensive than bank debt, but it's faster and comes with fewer restrictions. This lets companies delay bankruptcy even longer and accumulate even more debt before they finally collapse. So that's the system. But what does this actually mean for regular people on the ground? Segment 5. The real-world cost. In 2024, private equity-backed bankruptcies resulted in 65,850 job losses that were tracked publicly. The real number, including all the private restructurings, is almost certainly double that. In healthcare, PE firms buy hospitals, clinics, and nursing homes, load them with debt, cut staffing, file bankruptcy, sell to competitors. Now, in many regions, all healthcare providers within 40 miles are owned by the same parent company. That's bad for patients who have fewer care options. It's devastating for healthcare workers who now have zero alternative employers and no leverage to negotiate wages or working conditions. Research shows PE ownership of healthcare facilities correlates with higher patient mortality rates, longer ER wait times, and surprise out-of-network billing. Profit extraction is fundamentally incompatible with quality care, and reversing consolidation after bankruptcy sales? Nearly impossible. Real estate, 187 bankruptcies in 2025, 35% of all business filings. Office buildings bought at peak with 80% leverage are now 50 to 60% occupied. Rental income can't cover debt payments. Buildings are worth less than their mortgages. Refinancing is impossible. So they file, sell at a discount, and the cycle continues. This creates ghost corridors in major cities, empty towers, shuttered ground floor retail, declining tax revenue. Energy companies like Nikola and Sunova had customers and revenue. They just couldn't survive interest rate increases and policy changes under massive debt loads. The debt was designed for short-term PE returns. Long-term company survival was always secondary. Broader economic impact, fewer employers per region, fewer worker options, fewer market competitors, less innovation because leveraged companies can't afford R&D, less resilience for the next economic shock. For consumers, reduced choice and higher prices. 3 pharmacies become 1. No price competition. 2 grocery stores become 1. Prices rise. Multiple healthcare networks become a monopoly. Insurance negotiations turn one-sided. Now, to be fair, there are some arguments in favor of this system. Segment 6, The Other Side. Chapter 11 and 363 sales do sometimes preserve companies that would otherwise disappear entirely. Operations continue. Employees keep jobs short-term. Suppliers get paid. Customers access services. Creditors typically recover 40 to 60% of what they're owed through reorganization versus only 10 to 20% in liquidation. That matters for pension funds whose retirees' savings are invested in corporate bonds. And private equity doesn't always end in disaster. Roughly 75% of PE acquisitions don't end in bankruptcy, but that means 25% do, a rate far higher than the general corporate population. And even when operations are preserved, they're smaller, locations closed, staff cut, benefits reduced, R&D budgets slashed because debt service takes priority. Consolidation from bankruptcy sales reduces long-term competition. Short-term efficiency is gained from cost-cutting and mergers. Long-term market health suffers when 3 competitors become 1. The system prioritizes immediate financial recovery over long-term economic resilience, creditor repayment over market competition, financial engineering over sustainable business models. It's not inherently evil, but it's a choice being made, often without realizing it. Segment 7, What's Next? Standard & Poor's predicts elevated bankruptcy levels through 2026 as long as interest rates stay high. More junk debt is maturing. More zombies are dying. But the PE playbook hasn't changed. It's just gotten quieter and more sophisticated. The shift to private credit and out-of-court deals makes the crisis less visible. Official numbers might stabilize or even decline. But behind the scenes, the debt churn continues. So next time a bankruptcy headline appears, it's worth asking a few questions. Who owned this company? How much debt was it carrying? Who profits from the sale? And most importantly, is this a failure or is this exactly what someone planned? The private equity bankruptcy machine isn't slowing down, it's just getting better at hiding in plain sight. For more on how financial systems shape the economy, check the description. And if rethinking what bankruptcy actually means is worth it, subscribe.